our panel this morning comprises four. I'll be moderating the panel. One of our panelists will be here momentarily. He's on his way. But we have a great topic this morning. I think in many ways it correlates and follows on directly from the discussion this morning about global outlook, which I'm sure many of you noticed turned into a little bit of discussion around more U.S. activities as opposed to global, as well as policy implications, and in many respects, what the Fed can do and what the Fed can't do. So I think a couple things. One was commented on the process for questions, but I'd also suggest that probably many of the questions that you had that we may not have been able to get to in the last session are relevant for this panel, and you should feel free to ask those questions as well, because we spoke a little bit before we started, and not everybody on my panel agrees with what the last panel said. So I think there's a little bit of opportunity to have that type of discussion. So I don't think we could have a more distinguished panel than we have this morning. It's represented by Wall Street itself, which I think is fantastic. To my right is Abby Joseph Cohen. Abby is with Goldman Sachs and is president of the Global Markets Institute and senior investment strategist, well known, well covered clearly. She has been subject to a business case by the Harvard Business School her career. So that's an indication of the impact and the level of respect that exists for Abby and her perspectives on the markets, particularly domestically as well as globally, and we're very fortunate to have her with us today. To my left is Dick Peach. Dick is Senior Vice President of Macroeconomics and Monetary Studies at the Federal Reserve Bank of New York. So clearly, as it relates to what the Fed can do, policy-related matters, I think we probably have as good a person as any to be able to address any questions that you may have on that. Prior to joining the bank, he was Vice President and Deputy Chief Economist for the Mortgage Bank Association of America, so clearly understands the real estate market as well, which led a lot of the financial crisis activity. He is a graduate of Penn State, as well as has a master's from and doctorate as well in education from Maryland Fellowship. I didn't mention actually Abby's education. Abby, I believe, went to Cornell and then George Washington University. Our third panelist is Robert Weinstein. He's Managing Director of Credit Suisse, Private Banking in America, Chief Investment Officer of the private bank, responsible for investment strategy as well as asset allocation. He is also a Cornell graduate and a chartered financial analyst and has covered pretty extensively from a media standpoint as well, having been on CNBC and Bloomberg Television. So we spoke in advance of this panel, as you would expect. We tried to lay out three topics that we thought were relevant to today's discussion. But again, I'd like to comment that we're also going to ask, and we talked about this, is to have our panelists talk a little bit about the topics that were discussed previously in the last session as well. So structurally, we thought, really what are some of the broad implications of the policy setting process and activity down in Washington? And Abby's going to cover a little bit about that. Things in the area, obviously, of significant change in healthcare, stimulus, taxation, and other things like trade. Dick, we thought would be good to cover and provide some perspective on the U.S. economic indicators, particularly around trends, focused on the labor market, which got a good bit of discussion. Double dip, which got some discussion this morning, and then also try and translate it to a degree, as best we can, what it means relative to the New York marketplace and financial services. And then Robert, who I believe has now joined us, he's going to talk a little bit about, from a markets perspective, what he sees taking place. So Dick, I'd like to start with you. There was a lot of discussion in the last panel relative to global indicators, the interrelationship between the U.S. and China, Europe and the U.S., Europe and China, where growth is going to come from, poverty and wealth, et cetera. Obviously the U.S. continues to be, and for a long time will be, a major driver in global economic growth, but obviously very important to all of us here in the room about economic growth in the U.S. Could you spend some time maybe giving your perspective on those indicators that you think are most relevant as to where we sit today in the U.S. in relationship to what we're exiting from the last 2 years, and where do you see the economy headed? And again, there's a lot of sensitivity and focus in around the labor market, so maybe if you could touch on that as well.
Okay. Well, I think it's important to start by saying that we meaning economists in general, but also those within the Federal Reserve System, have known for some time, or anticipated for some time, that this was not going to be the typical cyclical recovery that we've experienced in the post-World War II period. Those past recessions tended to be induced by a tightening of monetary policy, which choked off activity in interest-sensitive sectors of the economy, particularly housing and spending on consumer durable goods. Then as inflation began to subside, the Fed would ease, interest rates would come down, and those sectors would be reignited. And you would often have just a tremendous surge of activity in housing with increases in housing starts in the first year of recovery of 50% in some cases. So it was anticipated that this is not that sort of a situation. Much has been written. There's the Rogoff-Reinhardt book. There's many other academic articles about the fact that this is more of a credit crisis, and recoveries from credit crisis tend to be long, drawn-out affairs, and so that was generally expected. That being said, I think, in particular, but I'm sure the FOMC has been disappointed with how sluggish this recovery has been. The unemployment rate is stubbornly high at about 9.6% at the moment. For me, the double dip and all this stuff is in many respects academic. I think from a policy making perspective, the only thing that matters is that the unemployment rate begins to drift up again. That's really the only thing that matters. And that is a very, very real possibility, because not only have we entered a period where it looks like growth will be below potential in the second half of 2010, but we've also had, during this particular downturn, a very, very steep decline of the labor force participation rate. And so as soon as the labor market begins to perk up a little bit, people will re-enter the labor force. That labor force participation rate will move back upward. And so the unemployment rate is likely to be stuck at an uncomfortably high level for quite some time. Then the last thing I'd say is that we have reached a point where trend inflation, no matter how you want to measure it, the conventional measurement is, let's say you take the consumer price index and exclude food and energy. That particular measure has been running around 1% right now. The Fed indicated yesterday, the FOMC indicated yesterday that this is below the target level or desirable level. And there is some concern, as was mentioned in the previous panel, that we have an economy that's very, very vulnerable to a shock. One potential geopolitical shock might be something that happens in the Middle East, and oil prices spike, and real consumer spending power is sapped because of it, and we tip back into a recession. And if we tip into a recession this time, it could bring that inflation rate even lower. So, we are in a very delicate situation.
I mean, I hear many refer to it as fragile, right? We're in kind of a
Yes.
fragile situation. You made reference to the consumer in the context of reaction to something like a very high spike in oil. Consumer confidence, at least from my perspective, and I'm not an economist, but reading a lot of stuff over time, there seems to be a lot of reaction to consumer confidence as well. The studies about where is confidence, where is it headed. When that confidence ebbs down, there's more market volatility. Can you comment, when you think about the kind of broader implications, and I think the labor component, right, the unemployment, when those statistics are heading in the wrong direction, has a probably disproportionate impact on consumer confidence. But your view of the consumer confidence, maybe element, and what the consumer actually can do to this economy if things start heading in the wrong direction.
Well, there's a lot of focus on the consumer confidence numbers. As a forecasting shop, we don't use it in any way. We think it's sort of a composite for a number of other indicators that are already out there: the unemployment rate, what's happening to employment growth, what's happening to household net worth, and et cetera. But it is, I think, a useful way to put all those sort of statistics together and summarize them in one thing. And it's low. Consumer confidence is very low. In fact, it's not much above where it was at the absolute trough.
Right.
So people are hurting in the United States in a number of different respects. People who have jobs are worried that they might lose them. Their home, their net worth is way, way down from the peak. If you're an older person, let's say 50 plus, you're bummed out completely because you're not going to be retiring anytime soon, if ever. And if you do have a retirement, it's going to be, you're not going to be doing the traveling that you had maybe dreamed about it at some point. And you know, if you look at all the different subcomponents of these consumer confidence measures, it's really driven to a large extent by the job market. Businesses are not hiring people who have been on unemployment rate for a long time. You know, there's a lot of research on what happens to people who suffer a very long spell of unemployment, and on average, they suffer a 25% decline in income when they ultimately do become reemployed. So now they're becoming reemployed at much lower salary, much lower prestige associated with the job. Perhaps there's no benefits at all. If there are benefits, they're reduced. So this is a very, very trying time. And as a result, you know, we and the other panel, I don't think anyone's anticipating that the consumer is going to lead the U.S. economy out of this recession.
No, I think that's a very valid point. Robert, one of the things that was discussed in the last panel was a lot of discussion around global implications, cross-border implications, and the economic ties from a trade standpoint, but also touched on, but not too deeply, was some of the restructuring that has taken place, or needs to potentially take place across Europe, particularly reference to Greece, but also know that Ireland and Spain and other countries have potentially some structural issues. There was reference to, you know, at the state level in the U.S., the need for some restructuring as well. One of the things I think is important to recognize is that while it's been a good, kind of hard 2 years, roughly speaking, financial crisis, it's not as if we were sitting perfect anyway from an economic standpoint, and there are a number of issues that I think that were impacting our economy leading up to the financial crisis. And many have talked about, and we've discussed this leading up to our panel, you know, is there a need for a global restructuring? You know, or is there restructuring actually taking place? So you had some thoughts about that. So maybe you could provide your perspective on the need for restructuring, both domestically potentially as well as across different parts of the globe.
Sure. And I mean, I think it's, you know, whether or not you recognize that there's a need or feel there's a need for restructuring, it is going on. And that's something that if you like it, you don't like it, you challenge it, it's very much in motion. I don't think that many of the problems that we are facing are necessarily problems, but they are representative of huge change, and so it becomes uncomfortable. We spend a lot of time talking about whether we're in a recovery. And when I think about that, a recovery by definition means that your definition of a healthy state is going back to where you were. And you're going to measure that by the number of jobs, the types of jobs, how people are spending, what they're buying, and so forth. And I find it nearly impossible to believe that we are going to go in that direction with all the changes. Now, this was all in place and in motion before the credit crisis began. And I would actually argue that we may be going through a change economically that is as major as, you know, the change from going from an agricultural economy to an industrial economy. And with that level of change, you know, there's a lot of discomfort, there's a lot of pain in terms of that change, in terms of defining what that means. And as far as an investor goes, that also means a huge amount of uncertainty, because the biggest danger that I think an investor can actually apply is linear thinking. You know, extrapolating what was to try to get to where you're going isn't going to work if all the pieces are shifting. So the restructuring that I would talk about, I think that, again, it's not recovery. It is a shifting of geographies. It is a shifting and change industrially, and it's a restructuring behaviorally. And in all those three categories, there's a lot going on. At the end of the day, the symptom here is the job picture, because when things are changing as dramatically as they are, employment and the nature and the color of employment has to change. What people have to do to be productive is different. The tools they have to do their work are different. The needs that people have are different. So think about two things that were in motion before the credit crisis. And you have to think about demographics and about technology. From a demographic standpoint, it almost became cliche for a while. We used to talk about the aging population to a point that there was almost nothing new somebody could add. But if you look at the number of people in the U.S., you know, 65 and older, I think it's somewhere around 30+ million. It's going to go to 50-some odd million in the next 10 years. And with that becomes a huge burden on government in terms of benefits and so forth. Now, the math says that you can't go to that in the last 5 years. to get a population 65 and older growing like that, that happened a while ago. At least in the math classes I took, that's how it works. And then you take a look at technology and the advances that have taken place there, and that is, at this point, a game changer. Technology and the technological changes that we're going through today, it's relevant technology versus the tech boom of the late 90s, which I sort of look at as more R&D. People didn't really understand what most of the stuff did. Many of the companies didn't survive, and the real key was if you had more letters in your stock symbol, you'd make more money, as long as you sold it before the bubble burst. Today, it's technology that people understand and they apply. Go on the premise from a geographic standpoint, and the emerging market story is not a 5-minute sideshow. It's for real. It will be part of what we need to deal with in every way, shape, and form for a very long time. What made that happen, and why is it happening so quickly? I would say technology has done that. If you think that capital and knowledge are the two basics for economic opportunity and economic growth, and I think that's true. You have to have money to invest, but you also have to know what to do with it. Technology has enabled the transfer of both of those in a way that we've never seen before, and that's why we're seeing this rate of change, this magnitude of change happen in front of us in a way that's very hard to digest. I mean, human nature doesn't digest and understand change necessarily of that magnitude at that speed. So our general reaction is to predict disaster. When we have a doomsday dashboard that we keep of all the things that investors come up with in terms of what's going to end the world next. And I think there was I actually saved the cover of one of the papers that in December, that the cover of one of the sections said Requiem for the Dollar. And it was like a memorial service program. And it called the dollar the General Motors of currencies and so on and so forth. I'll leave the paper out, but you can probably guess which one it was. And it's very useful because, the dollar came off, the dollar was on the doomsday dashboard, and it came off, and the euro went on 5 months later. That's the kind of change we're going through. I think when you think industrially, you have to think about demographics and the change that puts on the need for healthcare and changes its role and its employment role. And so you're shifting what people have to do for work. And that goes through with the technology piece. Think about the changes in advertising, newspapers, how people consume and how businesses distribute is a totally different paradigm now. And again, that creates job changes, different needs. People will get there, it's just not all that visible. And then behaviorally, I just challenge everybody here. Sit back for 5 minutes, think about how you live your life differently today than you did 5 or 10 years ago, the things that you do. And start to think in terms of iterative ideas and impact. We have devices out there. We started talking about this last year, these electronic readers that began, that now, look at the iPad, for example. This is not a commercial for Apple, by the way, although they are pretty cool. They're very cool. But the bottom line is if you think about what those types of devices mean, we all project sales and unit sales for those devices for Apple, and Steve Jobs has done a great job. But the real issue is, think about the fact that we've already made a transition in digital music. This is just another transition into digital reading. But once you go through it one time, the next time it happens faster and more easily. Well, what's the impact there? The number of music stores in this country went down from 7,500 in 2002 to about 2,500 today. You will see the same thing in the bookstores. In fact, they just closed the Barnes & Noble up on the Upper West Side. That's because of this. And so you are going to end up freeing up a lot of commercial real estate. And you're just holding the iPad thinking this is cool. Well, it impacts commercial real estate. That is restructuring.
Right, it's the add-on effects, right? So it's the disruptive technology, or in some cases, the disruptive distribution channel, right? So I remember doing some work in the entertainment space, and they say, for example, you put one of those red box DVD distribution components within a certain radius of a Blockbuster, and it'll put it out of business. Mm-hmm. And then you put 5 or 6 within a certain geographic radius, and it will cover the same volume as a Blockbuster. Mm-hmm. And we're disruptive technologies and disruptive distribution channels. In the earlier panel, discussed some of the demographics. You made reference to the changes in the U.S. demographics from an age standpoint. One one of the panelists had commented that while we have our own changing demographics, that actually in certain respects we're in better shape than some of the other major territories, whether it's in Western Europe or even China, given the policies in China around birth and children. What's your view? I mean, are we on par with other territories relative to this demographic change, or are we in a much more difficult position?
We have a different population here, and I think the aging issue is bigger in the developed countries for the most part than it is in the Chinas of the world, although ultimately they'll get there as well. Is it a bigger problem? I wouldn't say it's a problem, it's a challenge, it's a reality. Mm-hmm. We are going to have to deal with the fact that sovereign debt and our debt is going to be running at fairly high levels for a while, and that's going to have to be addressed through, if you don't raise taxes this year, it's still going to happen. The bottom line is, I think we probably are at a marginal advantage because the U.S. does have the sort of deepest, broadest, most established capital markets that are out there, and that means there's liquidity. It means that we're able to do the financing, and I think the dollar, despite the memorial service that they held, is in fact going to be around as the currency for a long time. The euro basically had to take a step backwards. I think that there's going to be a much longer wait and see when it comes to the viability of the euro as overtaking any other currency. So you have the safety trade going in the direction of the dollar today, and will continue probably to do so. That makes it easier for us to get financing. The other thing I think that people have overlooked a little bit, and I don't mean to sound like a Pollyanna, because in a job like mine you're supposed to be sort of cranky and negative about these things, but the reality is that there's a lot of debt being floated, that it can be floated. It's being done at extraordinarily low interest rates. And that is from the government standpoint as well as the corporate side as well right now. And it's real possible in a couple of years that, if you're floating 10-year treasuries at 2.5% right now, that's going to look like pretty cheap money down the road. And there is an advantage to that. It's just very hard to swallow today because the visibility isn't tremendous.
But I think that's the point, right? I mean, I think there's general consensus that rates will change. The question is, no one seems to know exactly how and when that transition is going to take place, and where do you position yourself?
So we'll make the assumption they're going up, and the question is timing at this point. They're going to stay lower for longer because we really do need to see jobs come back into play. The one sort of dry powder on the side that I think is going to make a huge difference that we don't typically have is the amount of corporate cash out there. If there's more visibility in this change, if company management gets more comfortable, we get past the elections, we get the rule book rewritten, all this regulatory reform understood. You can write the big book, but there are a lot of details left. There's something like $200 billion additional cash on corporate balance sheets today than there was 2.5 years ago. That's a lot of money that can go into the real economy once there's confidence enough to do it, and that goes to capital investment, it goes to hiring.
Right.
So
and
this
also,
is a possibility.
And added to that is the private equity space has a lot of money sitting on the side as well that they either need to deploy at some point or turn back, right? So that's going to drive, that's what's driving some of the valuation changes in the marketplace.
And private investors haven't really reached the riskier assets to speak of either. So where it looks like they may be invested, it's on a much more conservative side, which ultimately could be reallocated.
So Abby, we've talked about a lot of different things, obviously, between the two gentlemen. A lot of them either impact directly or are impacted directly or indirectly by policy setting. And you spend a lot of time thinking about what that means. And we have a pretty active set of people down in Washington on policy lately, certainly in the last couple of years. You think about healthcare, you think about regulatory in general, but certainly financial services, stimulus activities, taxation is a big issue, big topic, when, where, how, what do they do. So maybe if you could give some thought and share with the group your perspective on the implications, the kind of broad-based implications around policy and the impacts and measures that can have on us, obviously for a long time. Right? These are very large, sweeping policy issues that we're dealing with as a country.
Well, first, let me explain what my role is. In the investment research department at Goldman Sachs, we initiated a handful of years ago a group called the Global Markets Institute. And what we're doing in GMI is to look at any number of issues that any other market strategist or economist could look at if they were thinking about something other than what happens in the markets between now and next Tuesday. So perhaps the most important thing that we do is identify those factors that we think will play out over the course of years and potentially decades. And so it was very interesting for me to listen to Richard and Robert talk about some of these issues, because this is what we focus in on. For example, the demographic trends, what's happening in the labor force, what's happening in terms of productivity in the economy, which of course is linked to education and also the investment that companies make. So let me touch upon just a few of those. I could probably fill up all of our time talking about some of the other policy issues as well. And when I say all of our time, I think this conference ends the end of tomorrow. So I don't want to do that. So just by way of example, let me give you a few things that we think are critically important. First of all, let's understand that the problems in the US labor force did not develop during the credit crisis or the recession. The credit crisis and the recession dramatically exacerbated those problems, but they were there beforehand. How do we know? Our work a few years ago, based upon government data, indicated that over the last decade, the middle level family, that is the median family in the United States, had actually lost 5% in income relative to inflation. That is such a break with the past. You know, we're accustomed to having gains each and every decade in which the average American family has a better and better standard of living. And in fact, over the last 10 years, that simply has not been the case. And indeed, at the lower middle income level, the decline was approximately 10%. By the way, that might help explain why so many families were willing to dramatically reduce their savings rate and perhaps ultimately go into debt because they were trying to maintain their standard of living while their incomes were in fact shrinking. We then take it to the next step. We know, obviously, that there are industrial structural reasons why incomes were not holding pace. But we also take a look at some of the longer-term issues. And one of our biggest concerns has been what I will refer to as a deterioration in the educational system in the United States. Now, clearly, the current administration and the previous administration identified education policy as critically important. But let me give you a few factoids that help set the stage. If we take a look at educational attainment, and for this, I will just look at the percentage of adult population or young adult population that has a 4-year college degree, we have made no progress over the last decade. That too is a dramatic break from the last several decades. One of the reasons we became wealthier as a nation and income levels were growing and labor productivity was increasing decade after decade is our workers were better and better educated. That has not happened over the last decade. So just as some of the factors that the other panelists have mentioned have taken hold, this technological change, for example, and workers need to be better and better prepared, on average, our workers are not. It's even worse than that, by the way, and that is educational attainment by this measure, that is the percentage of population that has a 4-year college degree, has actually declined for young men. During this past decade, it has increased for young women, and maybe that explains why, when you look at the current unemployment rates, young women are much more likely to have a lower unemployment rate than young men. There's a difference in gender of more than 2 percentage points. And there's a wide differential by level of education. So for example, if you look at those people in the United States who have high school degrees or less, their unemployment rates are roughly in the mid-teens. Those who have college education and above, the unemployment rate, Richard, correct me if I have this wrong, most recently about 3.5%. So there's this very wide variation. And so when we think about what's not going right, first we have these absolute things that we're not doing properly in the United States. And let's not forget that on a relative basis, the rest of the world is not standing still. The rest of the world has in fact had much more aggressive educational policies in which their percentage of young adults going on to post-secondary education have continued to increase. And I'll give you one more factoid before I turn it back to you, Brendan, and that is, this is most clear in the area of what is referred to as STEM education: science, technology, and mathematics. What could be more important in this technology-driven world than background in these categories? And what we see is that our percentage of college students who are focusing in on these areas has in fact declined, while it is quite high in other places around the world. This, we think, is a policy matter. There's also a related policy matter. Currently, approximately 2/3, in some cases a little bit higher, of our current PhD students in the so-called STEM field, science, technology, and math, are non-US citizens. We have, for a long, long time, had a very large representation of non-American students in those categories, and it has been a good policy. We have created very strong ties between people who will become future leaders in industry, future leaders in academia, and in some cases, future leaders in their home nations. What has happened, though, is that over the last few years, we have become less welcoming to many of these people. Many of them are still studying here, but they are now much less likely to stay here. And that, to me, suggests something is not quite right in terms of our policies, including our immigration policies, where we are basically footing the bill for most doctoral students as a nation, either through university endowments or NSF grants and so on, and yet we then pull out the welcome mat and say, go home, take these great skills with you.
It's a very interesting, it has broad implications over all the education. And you even see it on the application side. I have two daughters are in college, and you go back the last couple of years, and the peak of applications, or at least this is what people will tell you, the peak of applications has hit the high, starting to come down. But you can also see by the acceptance rates and percentages when you do your homework that, you know, in many schools it's you know, over 53, 54, 55% females, 43, 45% males. So the incoming, that's not changing. So when you look at incoming, you know, academic applications and acceptances, you know, it's disproportionately female to male, which then just only further drives your point. And this whole immigration policy challenge, I mean, it's a true, it's to your point, it's, you know, just fundamentally something we have to deal with, because we do have underinvested in technology, engineering, medical by U.S. You know, students. And therefore, when you turn around and educate the rest of the world and tell them, we'd like to educate you, but we don't want you to work here, I mean, you're exporting a great amount of intellectual capital.
Absolutely.
Which is a real challenge. Just to turn back, and maybe you can give some perspective, gets back to kind of the broader stuff. Deficits don't seem to be going away anytime in the foreseeable future. We have state level structural deficits, we have the federal deficits, we have, you know, the funding of was mentioned earlier, whether you call them social programs, entitlement programs, wars, state issues, pension issues, enormous workforces at the federal and the state level. What does this mean in 10 years of deficits? I mean, how do we continue to fund and finance deficits at the levels that they're at?
Well, in fact, just last week I was asked to give a briefing to the board of directors of the Federal Reserve back in New York on the near-term fiscal outlook. And so I know this topic reasonably well, and it's not a pretty picture. If you take, everyone knows this CBO current services baseline, but that baseline right now is really not indicative of what current policy is. So what you really have to do is sort of go back and look at the budget that the president submitted back last February, in which case all of the tax cuts are continued indefinitely into the future, except those for higher income taxpayers. That gets a lot of attention, but in many respects is kind of a sideshow. It's $700 billion over 10 years, whereas extending the tax cuts for everyone else is like a $2.2 trillion price tag for 10 years. you know, we have no idea what's going to happen to defense spending, but it's unlikely that it's going to decline as a share of GDP. That's what's in the CBO baseline. So to make a long story short, we are off a sustainable fiscal path by at least 4 percentage points of GDP, if not more. And that's with tax revenues being well above their long-term average. So it's not as if this baseline is so gloomy because taxes simply aren't high enough. It's because this, you know, entitlement crisis is here. It's now, right? And you know, another just terribly alarming statistic right now. You know, it was mentioned that interest rates are quite low. We have debt held by the public that's roughly 60% of GDP, and yet we're only paying a little over $200 billion a year in interest. Over the next decade, debt to GDP is likely to rise to 90% of GDP. That's for the debt held by the public. And interest rates might return to more normal levels. And in that scenario, we're paying $1 trillion a year just in interest. And the risk that this just spins out of control is extremely high. In fact, it's so high that the CBO actually put out a piece recently on the risk of a financial crisis for the U.S. Yeah, because of this dynamic, and we're in a real bind on the fiscal.
Yeah, Abby, do you want to?
There was a comment made during the prior panel suggesting that the problems at the state and local level and their budget problems were very much related to the cycle, suggesting that it's really counter-cyclical spending and tax policies that are contributing to the duress at the state and local level. That may be true this year and next. It's not the real problem long term. The real problem long term for most state and local governments is horrible accounting. Now, that may sound really boring.
Particularly in this building.
That's right. But this is important. My team spends a lot of time looking at broad accounting issues. Pension accounting at the state and local level in the United States has been, to use a word, appalling. Even though corporate accounting for long-term liabilities like pensions and post-retiree health care expenditures have been in place for many, many years, not this case for state and local governments, where it was implemented just 2 to 3 years ago. And so we are in a situation where—
with a lot of resistance.
With a great deal of resistance, something called GASB 45 was finally put in place. And what we now know is that the funding gap exceeds $1 trillion. The number may be dramatically larger than that, but just think about the political incentives. Somebody who is running a town or a county or a city now, or let's say 20 years ago, would basically say to municipal employees, look, we don't really have the money to pay you. We'll keep salaries relatively low, but don't you worry, we're going to fund a pension for you, and you're going to have great post-retiree health care benefits as well. And then it was never funded. And it's that nut which has not yet been cracked and is something that is quite disturbing.
Let's talk about the market implications of that.
Well, yeah, I mean, you can start off with, you add to the problem that it was sort of poorly managed to begin with, and now all of a sudden we have an extension of life expectancy. A man relative to 1990.
Excuse me, only in this room would somebody say that an extension of life expectancy is a problem.
Yeah, well, but it is.
It's the accounting karma in the room.
No, I mean, the irony of the problem that we're in is that too many smart people came up with too many smart solutions. And I don't know that it's, Wall Street creating the deficit problem and all of the things that we're looking at is the doctors. So what do you do? Do you all of a sudden stop admitting the smartest people in med school? I don't know the solution on that kind of a problem, but there's no great answer to this one. But what you do have additional to any kind of accounting issues that you may have had on the pension side, I mean, certainly we just saw a headline the other day that return assumptions were too high. By the same token, I think that interest rate levels, inflation levels are going to be lower than what we had seen for a very long time, so that may offset some of it. But if you were planning on living for a certain period of time, and I don't know if Stanley really does that and buys into it, but all of a sudden you find out you're going to be around for 4 or 5 years longer, and you were assuming returns of 3-4% higher than what you're going to get, you're in a corner, and it's got to be dealt with. I think that where we need to be right now on all of this, it's not real easy, but I think that the problems where they're coming from seem to come to the surface pretty quickly, because that's where everyone's focus is. But it's more what has to happen to avoid that endpoint that seems to be, vaporization, basically, an implosion of everything that we know. And I actually, again, I'm going to sound more optimistic than I am as a person, but the reality is that having lived through a few decades of crises and predictions of extreme outcomes, the benefit of identifying all of these miserable final points in time is that if you know what that outcome can be, you can manage away from it. And I think that's the important part. If you think back in 1999, what we all spent our time on, I bet nobody even has it in their dialogue today, but Y2K was coming up. And how much time did everyone here spend on that? I was at a different organization back then, and the world was going to end. We were going to lose our bank accounts. There was going to be no water, which I never understood that part. The elevators would start and stuff. I mean, that's a pretty bad outcome. But we spent an awful lot of time fixing it before it happened. And we all went in New Year's Eve to watch the world end, and nothing happened, which was good. And so I think some of that's got to happen. The issues that, how do you manage away from what we're talking about now? And from a market standpoint, an investor standpoint, you have to look at that. The bottom line is the drivers of growth are going to be different going forward. So if you want to extrapolate where growth comes from and just go from where it was, I think we're doomed to some pretty bad answers and not getting anywhere. But the U.S. consumer is important, certainly, but it's going to be a different type of consumption. Somehow they can't kill us. We find ways to shop no matter what. We're very talented. It didn't die. We just sort of brought it down, but I'm not so sure that's so bad. We had lifestyles, at income levels that made no sense because credit was so available for a period of time. This is just a rationalization. But you start looking at the emerging markets and the pools of population that are there and moving up the income curve. The biggest changes in spending habits are when you go from low to middle income, not from middle to high, because then you start saving again. And maybe one of the other sides of the discussion that Abby pointed out, that we're educating people and sending them back, not letting them in here, is that there is an infrastructure in place in parts of the globe where there actually can be growth if it's managed correctly. And I think that you can't dismiss that. What we've got to do is get smart about how we run businesses. We can't, as a population, try to export our tastes and what we think is good. We have to understand what they want to buy and try to find a role in that and understand what the new businesses are. I mean, I look at everything, I go back to the iPad, all these touch screens that you have, and these little film things that you put on them, because they get disgusting actually, touch them for a day. I mean, those things, that's a whole business there that didn't exist to any meaningful degree. And you go and buy 2 of these screens, they're $30 or $40, and you've got to keep replacing them. Well, we didn't even need those things before. It's all sorts of little things out there that will end up, I think, filling at least some of the gaps that we're so terrified of today. If we get smart about how we sell some of our goods into China, we don't. There was a story about selling Oreos there, and it was a miserable failure because we sold big packages of Oreos, which is a food nobody ate. They didn't have the money for it, and there wasn't storage space for putting the big things in. And when they repackaged it to the small 8-cookie packs or whatever it is that here you would eat before you check out of the grocery store, if you bothered to go, because you actually shop online anyhow, so you don't bother going, that actually then made a difference.
Right, and that probably lasted a week. And actually also I remember reading that article, actually, one of the things they also did was they took other products effectively and called them Oreos instead of trying to force on that population the exact composite of what we consider an Oreo cookie to be. They actually took something more local, converted it to a degree, and then called an Oreo, but it's not the same. It's much like McDonald's has done a great job globally as well as adapting to the local environment on its product offerings and while expanding its business.
Well, when McDonald's tripped, like in Latin America, they tried to sell American breakfast into, I think it was Argentina or somewhere, and you just don't eat the same type of breakfast foods.
Right.
So it was a problem until they recalibrated what they did. That's where we've got to get smarter, but we can. And people have to be retrained into that kind of a mode and that kind of environment. It'll take a while. As I said, there's pain when you have that level of change. But I start my day just for years. I learned you can't say this time is different in this business. It's the fastest imitation to a smack on the back of the head, because it's usually not different. But every 100 years or so, maybe it is. And we, I think, could be going through that type of a time. We haven't labeled it yet, but that's where we are.
Effectively a transition, is your point.
Oh, it's more than a transition. It's a transformation.
Economic theory actually has addressed this question about these big, broad changes. And the theory basically says is that once a generation, or sometimes once every 2 generations, there really is a huge adjustment. And let's call it in technology. And when I say technology, I don't necessarily mean computer technology, but you think back to the late 19th century, the shift from agrarian to industrial. Think back to the post-World War II period, shift from heavy-duty industrial to more sophisticated industrial, and then of course the shift in the 1990s, the shift towards more IT-related. What is different about the current period versus those other successful transformations, again, has to do with how we're preparing our middle-income children. And we're not doing as good a job. When we did the shift, agrarian to industrial, most state and local governments put in place free public education. We created the world's largest group of literate workers. At the end of the Second World War, the combination of the GI Bill of Rights, which allowed every returning veteran an opportunity to have free post-secondary school education in combination with the growth of the great state university systems, led to this huge expansion in the number of college graduates in the US, and also large percentage of total population. And then we think about what we're doing right now, and there is no commensurate adjustment in what we're doing with regard to education, or for that matter, training and retraining. So much of the retraining of workers takes place in the United States in entities like community colleges. So for example, a lot of the young men who 10 years ago decided not to go to a 4-year college program because they were going to make the big bucks in construction, and now find themselves looking for new vocations, would normally turn to community colleges to be trained in something else. But community colleges in the United States are funded by state and local governments, reference back to previous comments about the financial duress there. So that to me represents a problem, but also an opportunity, because to the extent that we can isolate where there might be some solutions that might be very helpful. I don't mean for this to be a commercial message, so my apologies for that. But just this week, Goldman Sachs had a very large event over at LaGuardia Community College, which for us is a magnet program. It's part of our 10,000 small businesses, in which we are providing the funding to the community college system so they can help retrain these workers, and also small business owners who did pretty well during the rising tide, but when things got tougher, they discovered they needed to know more about bookkeeping and merchandising and so on.
I think that at the core is such an important part of what's going on. It is the educational piece, it's the training, it's knowledge, and then what to do with it. Where that becomes an even bigger challenge is if you think about the pace of change. It's not just the fact that there's change. It's very hard, and that's going to be our challenge for several years, is getting people up to speed quickly enough to digest it. And I just look for statistics on the accelerating pace, and forget about the magnitude of change. You look at something like a Facebook that went from 50 million to 500 million users in 2.5 years. 500 million, the population of this country is 300 million. That is incredible, with huge changes in the underlying demographics. It's not a college tool. Half the users, or almost half, are 35 years old. You look at, again, I sound like an Apple commercial here, but and I don't mean to, but when the iPod only came out in 2001, and you see the impact just on the music industry. It took something like 30 plus months to sell 3 million of them. And then you take a look at the Kindle, which was sort of the first standard electronic reader, and it took 2 years, so 24 months, to sell 3 million. And then you look at the iPad, which came out in April, and it took 80 days to sell 3 million. And right after that, this new iPhone came out, and it was something like 2 or 3 weeks to sell 3 million. I mean, that's how fast people are adopting. The bottom line is, the more people use these things, the more they use them, the more comfortable they are, the faster the change goes through, and it permeates society. And that is where the changes become so important. And that's where the point that Addie makes about education, you're actually trying to educate on some things that we don't even necessarily know about. The challenge, I think getting some young people sometimes is the best way that you can deal with some of this, because they're not jaded by real life. They don't walk in the door with a whole lot of baggage, and that may be one of the places that we're going to...
Different perspective on many levels.
There's no doubt.
Before we go to Q&A, I guess anything you'd like to add to the dialogue we've been having?
Well, there were, the previous panel, there were several statements that were made that I disagreed with in a number of levels. At the New York Fed, it's a very academic environment. If you say something like, oh, well, the early 2001 tax cuts did not stimulate investment, you're going to get smacked in the back of the head, and someone's going to say, well, what's your counterfactual? What would they have? What would investment have been absent those tax cuts? So these are very, very difficult statements to say.
Easy to say.
Easy to say, but really they don't amount to a whole lot. But there was one in particular that I wanted to address, and that was that one of the gentlemen said that the Federal Reserve really can't do any more because it's in a liquidity trap. And I just disagree with that very strongly, and would just like to mention that think about what monetary policy does. Very simply, I grew up in the real estate industry. It lowers the long-term rates and it raises long-term rates, right? So even though we're at the zero bound with regard to the federal funds rate, the Federal Reserve can continue to expand its balance sheet, continue to drive longer-term interest rates lower, and therefore, at the margin, stimulate some additional housing spending or some spending, perhaps on consumer durable goods. So, we have things that we can do in terms of large-scale asset purchases, in terms of communication, those sorts of things. And then one of the things that we should really take from the crisis is the ingenuity of the Federal Reserve in terms of dealing with sort of unprecedented developments. And I'm going to mention something to you that is first going to be raise a chuckle, but don't dismiss it, and that is to issue currency with an expiration date. All right? This is the equivalent of Ben Bernanke's dropping money out of the sky. But this is something that in academic circles is discussed in all seriousness. And so we're not out of ammo by a long shot.
Okay, so we're going to open up for some Q&A. So if you could raise your hand, we do have mics that we'll get to someone over here.
Thank you. If we use for purposes of this discussion that inflation is an increase in the money supply above and beyond the increase in productivity, the velocity of money right now is very, very low as it's been in the 30s. If the velocity of money picks up, what will the Fed do as a counteracting measure? And where are you looking for that velocity to pick up to begin with? What are the early telltale signs?
Well, we get weekly and daily data on what's happening to the balance sheet of the entire banking system of the United States. So the notion that all these reserves are somehow gasoline laying on the floor just waiting to explode and we won't have any, prior warning of it is really just not correct. We will be able to see when bank balance sheets begin to expand again, and the money supply will begin to expand again in loan growth. And at that point, the Fed has a number of different options of trying, people at the Fed sit around, man, we can't wait for the day when we have to raise short-term interest rates. We can't wait for the day when we might have to raise interest on reserves to try to discourage banks from using these reserves to create loans. And then lastly, we can begin to sell these assets back into the private market. I mean, these are just the standard tools of monetary policy. I think people are, making way too much out of it. It's really kind of a simple process.
So you would welcome some inflation coming back into the system?
Absolutely. I mean, one of the things, if you read the FOMC statement carefully yesterday, lower actual inflation and lower inflation expectations cause an undesired tightening of monetary policy because they raise real interest rates. So we would be delighted to see some movement back upward in like tips-based inflation expectations.
I would add just a personal comment. Not mentioned in my biography before is the fact that I started life as an economist at the Federal Reserve. And this was a few years ago, and then the problem was rising inflation. And the fascinating thing for me is that the intellectual processes at the Fed today are very similar. Back then, we were looking at a rising inflation environment, trying to figure out what dislocations that would create in terms of interest rates, in terms of lending policies, and so on. In many cases, the intellectual process is the same, but the challenge is very different right now.
I would just, if I could just add a very fast comment to that. I've never been an economist or worked at the Fed, but at the end of the day, if you want to see the impact of very low inflation or deflation, just look at Japan. And very, very simplistically, if you think prices are staying stable or they're coming down, you're just not going to invest or buy necessarily. And that is the absolute killer to growth over any kind of time period. So we've seen it.
Question right there, and then we'll go to you.
Hi, I'm James Sweeney, Global Strategy at Credit Suisse. I notice services consumption, half of GDP, has had no recovery. It's completely flat, basically. How do we think about that in terms of its sensitivity to what the Fed is doing? And how do we think about that in terms of some of the structural labor force factors that we've mentioned? Because I think that very weak household formation is a big part of the slow pace of services expenditure. Things like housing services basically are correlated with this. It seems to me it's not very policy sensitive at all, and that it will take some time for the demographic forces to allow this structural kind of real recovery to take place. How is the Fed thinking about those things?
Well, again, I want to emphasize that these are my views, not necessarily anyone else's. That's probably not anyone else's. But I've done a lot of work on decomposing inflation between what we call core services, non-energy services prices, and then core goods prices, non-food, non-energy goods prices. And back in 2002 and 2003, when we had a bit of a deflation scare in the U.S. economy, we had falling goods prices, rapidly falling goods prices, but actually the rate of increase of core services prices was still running around 3%. So I was arguing that this deflation scare was way overblown. And I personally think that the services prices are a better indicator. The Fed is supposed to monitor inflation, but what inflation rate, right? What inflation rate should the Fed be focusing on? So I've been arguing, focus on these core services prices because that's a better indicator of the level of resource utilization within the United States. Right now we have the opposite situation. Core services prices are actually low and they're continuing to slow, whereas overall core inflation is being held up, at least for the time being, by relatively rapidly rising goods prices, things like used cars and automobiles in general. So that's why I think the current situation is so alarming, if you will, or troubling, because these core services prices are so low. Now there is one ray of hope recently. Believe it or not, the rents that tenants pay to landlords have begun to pick up a little bit recently. There's several apartment industry measures that we look at that indicate that the owners of these buildings, think that apartments, the market is tightening up a little bit. And if you look at some of these measures of the prices of real estate assets, prices of apartments have actually begun to firm and move back up, whereas all the other categories of real estate asset prices are still relatively low. So I take that as an encouraging sign, but I'm afraid we are in an environment in which these services prices are going to be quite relatively low because of the situation that we're in. For example, people are postponing or doing without medical care and dental care, which 5 years ago they would have gone ahead and purchased. So we're seeing a broad array of services prices under downward pressure.
Okay. There was a question there, and then we'll go to the gentleman right behind.
Hi, I'm Mehmet Özaves from JP Morgan. How effective is the monetary transmission mechanism working? We have record low interest rates. At the same time, housing starts and home sales are also at record low levels, and consumption growth is very sluggish. So if the Fed purchases more assets, how effective is that going to be?
Why don't you start, and then I'll follow up with the market's perspective.
Okay. Again, what's your counterfactual? I think that when the Fed began the large-scale asset purchase program, the spreads between mortgages and 10-year Treasury was an extremely high level, and the large-scale asset purchases were, at least in my view, very effective in narrowing that spread and helping to get some of the traditional transition mechanisms going forward. No one knows with any precision what the translation from asset purchases into lower interest rates, but there's a rough rule of thumb being bandied about that maybe every $250 billion of additional purchases would lower long rates by about 10 basis points. This sort of 10 to 1 relationship. And it is true that the housing market is sluggish right now. I think it would have been a whole lot more sluggish absent these purchases. And I think further purchases would, again, at the margin, help to support the housing market. But it's not with the expectation that all of a sudden the housing market is going to turn around on a dime, and we'll go back to having 1.5 million housing starts. But I think it would, again, at the margin, firm up demand a little bit, help people have a little bit more confidence that perhaps we've seen the low point in housing prices. I think for me, that's the biggest obstacle to the housing market at the moment. Previous speakers mentioned that housing affordability is extremely high, the highest it's been in 40 years. But there's this nagging fear that we haven't quite seen the low point in terms of home prices, and as a result, there's this huge bid-ask spread out in the housing market.
I would reiterate the following point, and that is, during the credit crisis, we were at historic spread levels. So, for example, corporate bonds were priced to yield dramatically more than treasuries of comparable maturities, and in many categories, many ratings, those spreads had never been seen before. We were also in a situation where corporations and borrowers other than the U.S. government had no access to the capital markets. That included corporations, it included some state and local governments, it included universities and others that really had no financial difficulties. I think with the Fed moving in and undertaking a number of the programs which they did, we in fact did see a return to stability much more quickly than we otherwise would have. So for example, if we look at the most recent market indicators, we see that those credit spreads are now roughly back down to normal, number one. Number two, the entities that were simply unable to have access to the debt capital markets 2 years ago, and then got access only if they had government guarantees, they are now back, and they can borrow, and they can borrow at reasonable levels, and that's something that we think is quite helpful in terms of allowing them to restructure their balance sheets in a way that will be very cost effective.
Robert,
yeah, I mean, you know, Abby brings up a good point. It's really not that long ago that the capital markets just didn't work at all. And if you think about the day that General Electric could not go in and fund, you know, get funding in the commercial paper market, I think it is almost scarier when you look back at it than when we actually lived through it, because that was an indication that the world could have ended, quite frankly, in any way, shape, or form as we knew it. But that's how severe the economic situation was. And the fact that the government, whatever textbooks you want to read about free markets and all that, sometimes you have to be practical. And I totally believe that it was the action that was taken that was significant and so quick that actually saved us. And you look back on history, had that been allowed to go in the direction it was going in, and as quickly as it did, the worst problems in history, social problems, are derivatives of economic hardship. And the most shameful moments in human history are a product of that. We were at a point where things had just stopped. So I think it was absolutely critical, and it was effective. Now, what we have is a question: how much is enough? How much money will it take to get things going? I would argue, because I'm big on semantics along the way, this wasn't a credit crisis or anything like that. It's a confidence crisis. And it has been an exercise of figuring out how much does it cost to buy confidence in the futures market in that. There's nothing that you can go to sort of get a gauge. But initially, with the first chart program, it was $700 or $800 billion. We saw what happened when that was rejected. I don't think there was magic behind that first number. I'm sure you know more than I do about that. Nobody called me to say, is that enough? But the reality was, I think it was to get attention, so that people would believe that all that nasty paper that was on the books of the banks would be taken somewhere where it could be held without damage to the economy. Let the banks go back to lending, the government will hold it, and ultimately all will be right with the world. They got attention, but we saw what happened afterwards.
we're going to just take one more question right there. Hopefully it's not too
Thank
complicated.
you. I'll try to be quick. Rick Willard, Rule 7 Media. From what I've heard in the panel today, it suggested that we'll soon perhaps reach an inflection point where our competition needs may overwhelm our competition resources globally. If that's the case, then we would soon reach a singularity point or some sort of event horizon where we could not necessarily predict, since it's such a different sort of recession, what would come after. If that is the case, assuming that may be the case, what policies do you think would be most effective in essentially addressing the unknown?
Well,
sorry, I tried to put that as best I could.
That is not at all a simple question. and therefore there cannot be an appropriate simple answer, but given our time constraints, I will try. One thing that has been lost in the discussion from the beginning of this morning is the fact that we are out of recession. And so despite the incredible weakness in housing, and despite the fact that consumer confidence is very low, and business confidence isn't what we would like, and bank lending confidence isn't what we would like, we have grown. And when we take a look at the sources of economic energy, we see that the United States, to your point about global competitiveness, exports have done reasonably well. Industrial production has grown 10% year on year in the United States. You wouldn't know it from some of the doom and gloom that we've been hearing, but we do see some areas of strength in the US economy. It certainly hasn't been the usual increase in demand at the beginning of the cycle for housing and autos, but it has been other things. And so I think what we're all talking about here is that for the United States to continue to do well, the preconditions have to be in place. I've already talked about it, and that is getting our workforce ready. That's the labor. Number two, we have to give them the right equipment, i.e. the capital to work with. That's the investment in technology. A survey we did just a couple of months ago shows that 70% of large US companies are planning to spend more over the next 12 months for information technology and computer-related equipment than they did the last 12 months. So that's another step in the right direction. Some of the other things we need to recognize, because you asked again about global competition, is what is everybody else doing? And here, a very quick answer. 2 years ago, there were some pleasant surprises. One was the rapid action by the Fed and the Treasury, and the efficacy of that in terms of getting the financial markets out of their seizure. That was great, and they had company with policymakers outside the United States. The second very big pleasant surprise was that there was no movement towards trade protectionism. If you think back to the 1930s, it wasn't just the seizure of the markets in 29, 30, 31, it was also bad trade policy in the US and elsewhere, Taft-Hartley and so on. 2 years ago, October, leaders of the Western world and others for the first time came to Washington just a few weeks after their meeting here in New York at the United Nations, and they reiterated their view that we were all in this mess together. There was no movement towards trade protectionism. One of the things that we need to be looking at going forward, because you're asking about from this point, is number one, whether those constructive policies will continue in terms of as little trade protectionism as possible. The United States is a huge exporter. We benefit from keeping protection barriers low, number one. Number two, the long-term issues that I've already discussed with regard to competition. And number three, recognizing that our success as a global economic leader depends upon recognizing that this is not a closed economy. We have a very significant stake in not only buying things from other nations, but being able to sell things to other nations, and also having a good flow of resources, capital, and people across borders.
Thank you to our panel.